Today is Sunday, July 5th, and this is a post-market review for the week ended on Thursday, July 2nd, and a look ahead to the week to come in the stock market. First of all, let me say that I hope everybody had a happy 4th of July holiday, and we are now going to start this presentation by reviewing the BLS report, the jobs report that was released on Thursday, and we're going to see if we can look at the numbers and the details and find out some different narrative than we've heard from the media. The jobs report is very easy to find. All you have to do is to go to the BLS website and you're going to find a PDF form. This is the report. I already looked through it and combed through it. I already chose the most important parts of the report, and I'll put it together for you. So I'll show you these snippets from the report. Of course, the big number that the Bureau of Labor Statistics released is that 4.8 million Americans are now employed. We have gained more employment at the tune of 4.8 million in June. So unemployment effectively went down to 11.1%. My only question here is, in the last report for the month of May, they admitted that there was a technical error, a misclassification error, that would have risen the actual unemployment rate by 3%. So is that accounted for in this new unemployment rate, or we just forgot about the error and we didn't count it? Because if you counted, I'm assuming the real unemployment rate would be 14.1%. But let's just pretend to take the Bureau of Labor Statistics numbers as they gave us. The unemployment rate is at 11.1%. And by the way, I'm not playing the devil's advocate by reading this report to be bearish or to be negative. I'm doing the job that I'm supposed to do. The media tells you one thing, the Bureau of Labor Statistics releases one number and concentrates on one number. The administration celebrates the number, but you have to comb through it and find out the details. That is my job, to find out if there are any holes to look for in the report. And reading through this report, I can say that this report is the peak of the so-called recovery for now, because it is a lagging indicator. It was conducted between June 7th and June 13th. That's when the survey was conducted. However, we have the weekly unemployment claims by the Department of Labor. And you can go to the Department of Labor's website and find it. Here it is. And when you scroll down and you look at the weeks of June 20th and June 27th, the most recent one, you can see that initial claims are down, but they didn't go down as economists and experts expected. Perhaps it is a turning point back to more weekly jobless claims to come. Remember, the BLS report ended in June 13th. This is here, ending on June 27th, telling you that unemployment claims are not dropping by the rate that the economists are predicting. Let's not forget that we had a piece of news last week that over 50% of Americans are unemployed right now. And when you contrast that with the BLS report, find a little bit of contradiction here. On one hand, we have 50% of Americans unemployed. On the other hand, the BLS report is saying, hey, the employment or the unemployment picture in the economy is getting better. However, there are some technicalities here you need to pay attention to. The BLS report, and I'll read you this word for word. The BLS report says, in the establishment survey, workers who are paid by their employer for all or any part of the pay period, including the June the 12th of the month, are counted as employed, even if they were not actually at their jobs. What does that mean? Remember, a lot of businesses applied for the PPP loans. The conditions on the PPP loans is to continue to pay your workers. So even though these workers, in all intents and purposes, are unemployed, yet they're receiving money from their employer from the PPP loan, are counted as employed here. So perhaps this report is underestimating the real number of unemployment. Also, keep in mind that the BLS report was conducted between June 7th and June 13th, before the spike in coronavirus cases. Let's look at the CDC website and see where we are. Here's the week where the BLS report ended, June 13th. We didn't have any spike then and closures. And look what happened after June 13th. Cases spiked all the way to all times high. So this is why this report is meaningless, because it is a lagging indicator. It means nothing. Yet the market celebrated it, the president touted it, and it's still too early to make any conclusions from this report because the cases are rising, it is lagging for now, and we just can't take this report seriously and make decisions in the market based on it. And you can see from the report that the majority of the jobs gained were in the leisure and hospitality sectors, and we know that these are the sectors that are hit hard by the coronavirus closures, and we have reclosures now. So we have to assume that a lot of these jobs will be lost again. Matter of fact, when you break it down, jobs in the food and drink sector were up 1.5 million. So we're talking about bars, we're talking about restaurants. 1.5 million is 31.25% of the 4.8 million the Bureau says we gained in jobs during June. Bars and restaurants are being closed. Governor Abbott of Texas, Governor Newsom of California, and of course Governor Clown DeSantis in Florida all closed bars and restaurants because of the surge in coronavirus cases. Another important piece of statistics to look at in this report is the majority or the highest number of segment in the society, in the demographics of society, that saw increase in their employment status are teenagers, 23.2% up from last month. So we're regaining the McShitty jobs. We're regaining weaker jobs held by teenagers and bartenders and food servers that are more threatened by the closures or the reclosures from the coronavirus. This is perhaps the hidden number that nobody was talking about in the report. It's the most important number. People should talk about it more. The permanent job losses in the economy up 588,000 to a total of 2.9 million. This is a very important piece that nobody talked about. The permanent job losses. These are people that got the pink slip. They got the boot. They're out. They're done. They're never going to get their jobs again. These people, the increase in this number, 588,000, is a massive number in permanent job losses. You don't have to be a genius to figure it out. Even companies that are doing well during the coronavirus crisis are figuring out, hey, we don't need to pay for conferences. We don't need to pay for travel expenses. We don't need to pay for office spaces. We can do a lot more with less. We can do a lot more with less workers. We don't need them all. And they're starting to fire workers permanently. They're learning how to be more effective. That's good for the individual companies, bad for the macro economy. All right, let's segue from the BLS report to the technical analysis of last week. Before I start, let me show you a little bit of my calls before the week started. These are my calls from June 28th, the Sunday that preceded last week's market action. If you remember, I told you it's going to be a low volume week, and it has a bias to the upside historically, and I recommended making bullish trades in Microsoft, Apple, and Facebook. So this is what we expect. Let's say that the market opens down on Monday. That would be an opportunity to cover your shorts. If you haven't covered yet, take profits. And it would be also an opportunity to buy a little bit. You don't have to take any risks. Certainly, I might not make any trades for the week. I don't have to. But if you have to, you might see buying the opportunity in names like Facebook and Apple and Microsoft. And just as I predicted, the week ended in the green, bigger than I anticipated, granted, but ended in the green nonetheless. And if you see, Facebook ended the week over 8%. It was a lot higher than that. It was over 10% actually, but it gave a little bit on Friday. Apple 3% almost, and Microsoft over 5%. So if you followed my advice, you made big money. I also guided you on Twitter Wednesday, before the week ended, I told you to close your trades if you made weekly option bets. Close your trades, book your profits, and what do you know? By Thursday, the end of the week, because we didn't have Friday, we had the holiday, Facebook was down a little bit, over 1%. So I'm guiding you like a baby, step by step, on YouTube, then on Twitter, and telling you how to open the trades and when to close them. And if you followed my advice, you were successful trading last week. Last week was also a bad one for the airlines, the cruises, the banks, the hotels, garbage stocks. They pop in the morning and they get sold off because the people who are pumping and dumping these stocks are realizing that their thesis is pretty much collapsed because of the resurgence of the coronavirus. And now they're using every pop to sell and get out of the names. I warned you a long time ago on June 15th in my video about the travel stocks, the garbage stocks. I told you short the rip in them. Conclusion: we remain cautious, we remain bearish, and we continue to buy the VIX to protect our long portfolio, and we continue to short the rip in airline stocks and weaker stocks that are being pushed by day trading or in gambling activities. These names are weak, they have no merit to go up, and when you look at the real charts in the economy and the recovery, specifically for the airlines, hotels, cruises, they don't look good. So we continue to short the rip in these weak names. Also on Twitter, I gave you the Zoom indicator. I told you every time you see the airlines and the travel stocks pop in the morning and Zoom selling off in the morning, when you see Zoom getting bought, the dips in Zoom getting bought, that is a signal that there will be a reversal in the travel stocks to the downside. And this indicator worked like magic this week. Here's a tweet from the gambling morons at the DDTG whatever. We fly in this country. Okay, dude, fly alone, because people are scared to fly. They're not flying yet. And I'm not worried about this guy. He has a $100 million net worth. If he loses all his money, he moves on to the next gig. I am worried about the younger amateur investors who are following him, who will lose their money because they're following bad advice. But I guess some people need to learn the hard way. That's how you learn investing. Let's take a look at an important chart here in the VIX from the week. The VIX went down. I already closed the gap that I told you about here. My line in the sand. If you close the gap and you continue to go down and you cross the blue line right here, I'll remove this because I don't know what that is. If you cross the blue line and you close below it, that's the moment when I'm going to reverse my stance on the VIX. And I will say, short the VIX, don't buy it. And that would be bullish news for the stock market. But look what happened. We went to the gap, reversed back up. The VIX is not finished yet. I continue to buy the dips on the VIX. This is the most important part of this video, what to look for next week. Everybody's looking for a resolution of this consolidation box right here. Are we going to bust through, break to the upside and find new high? Or are we going to break down and test these levels right here at 2,775? We have two cases to study from recent history to find out or to predict with accuracy how the conflict here will resolve. So we go back to this case from August 2019. We had a very similar look, a breakdown and a consolidation. Technically speaking, very close, very similar, almost identical to where we are right now. Here's the thing. This was a result of the trade war with China. There was a little bit of a sell-off, consolidation, and then we marched to all-time highs. The market was assuming that the trade war with China and the skirmish, or whatever you want to call it, is temporary because it was all bluffing. The president doesn't want to break the stock market and start a conflict with China. This is why this was a buying opportunity. It was a consolidation to invite buyers, and the buyers showed up and they pushed the market higher. Here is the second case from October and November 2018. You see the breakdown candle and the consolidation again, inviting buyers, any buyers, so we can rescue the market, push it higher. There were no buyers. The sellers showed up and sold it down. The reason for this sell-off was the Fed. The market wanted to send a signal, a strong signal to the Fed, because the Fed was hiking rates. And the market sold off, told the Fed to back off, and continue doing QE. And once that happened, the Fed backed off, the market recovered easily. Right now, at the consolidation that we have in front of us, we have bad news on the economy, we have bad news on the coronavirus, etc. We have that negative piece of news to pay attention to. We have positive case or positive piece of news, which is the Fed liquidity and continuing to support the market, and also the government stimulus. There's another government stimulus perhaps, and that will push the market higher. The thing that I look for is market psychology, because the market technicians or the technical analysts that you guys listen to on YouTube are telling you this is a bearish flag within a bullish flag, within a bearish flag, within a bullish flag, and one of those gonna work somehow. Well, buddy, if I'm paying you $400 for your stupid course, you better tell me which one is gonna work. And the truth is, they don't know. This is their insurance policy. They talk from both sides of the mouth. They tell you, hey, if it breaks up, oh, it was the bullish flag. And if it breaks down, oh, it was the bearish flag. This is all wizardy kind of voodoo science. It doesn't work. There's nothing you can do in making rational decision-making based on that information. Market psychology, on the other hand, is very different. You look at this consolidation from the point of view, we broke down and we're inviting buyers. We're waiting for buyers to rescue the market and push it higher. We tried once to break this line, this blue line, this price that we struggled to break through before we collapsed in March. We're struggling again to break through. We're inviting buyers over and over to rescue the market and push it over this blue line. It is not happening so far. Watch how fast the dips were bought during this leg, this recovery leg. Very fast. Fewer days here than here. Fewer days here than we are right now. Fewer days here. Just one day. Similar look here. If they wanted to push the market higher, they could have done it within days. But this consolidation is worrisome because it tells me two things. Number one, the people who bought the dip here and scored big along the way in the recovery are looking for an exit. But they don't want to sell at these prices. They're not high as they can go. They're waiting to say, hey, dip buyers are always there. They bought the dips along the way. This could be another dip where they can buy and push the prices higher. And then when we pump and dump them, leave them holding the losing bag, and we score our profits. However, the buyers on the sidelines are not stupid. They're very smart right now. They're looking at this and they're saying, this doesn't look good to us to jump in and buy the dip. We need something more. We need more of an insurance policy to jump in. They're like the guy in Vegas when you're playing blackjack and you're having a bad shoe. Somebody behind you slurping their drink and watching the game, but they're not joining in. You know that guy. You want to stand up, you want to smack the drink out of their hands and tell them to take a hike. But what they're doing is very smart. They're looking at tables, and tables that are not hot, they move table to table until they find the table that is hot, and they sit in it. This table isn't looking hot right now. Remember, we had a short holiday week, trading week, so we're not going to make any conclusions right now. The push higher didn't cross the blue line and push the market higher, and the reason is it's a low volume. So we'll wait. This is not a conclusion, but next week is the conclusion. This coming week is the conclusion. Either they buy and push the market higher, or we're going down. And my bet is they could have pushed it higher way before. What changed now? We're only seeing negative news coming out. My bet is we're going to break down to the downside and break out of this consolidation box, at least from the level of this candle right here. It is a bearish case either way. Either we break down right away, or they're going to pump, push it higher, and then get out, sell their profits. You're going to have this double top going on right here. We can mark it for you. Right here. This is one top, and we push higher, stop at this top, and then go down. Here are the two keys for the market action next week: Apple and Tesla. As Apple goes, so will the market. You look at this chart right here. This is a weekly chart of Apple. Look at the number of green candles. The stock is on a tear. It just keeps getting bought and bought and bought. There's one problem though, and I explained that to you in previous videos. You can go back and watch them. Every time when you have big moves like this and you make a higher high on the chart, when you make a high and correct and then move forward to make a newer high or higher high on the chart, yet you're making lower high on the RSI, this is a recipe for disaster, aka correction, because this move is weaker than the move before that preceded it, yet it went higher. That means it is due for correction. Where is the correction, you might ask? Watch the 20 weeks moving average. Every time it diverges up or down, it goes back to visit the 20 weeks moving average. It's a magnet. It's the center of gravity in the weekly chart. And now we diverged higher, way extended off the 20 weeks moving average. It's only logical that we're going to take a break, go down and visit the 20 weeks moving average. You can wait and consolidate a little bit and let the 20 weeks catch up to you. But the extension here is so high that we're going to have a big correction either way to touch the weekly average. My advice, if you bought Apple on the dips here, this is your time to take profits, book your profits, wait in the sidelines and wait for a better entry price. Here's a weekly chart of Tesla. The stock is an absolute tear. And the reason is shorts shorted for no reason here. They just shorted because of an emotional attachment against Elon Musk rather than the fundamentals. And what do you know? They pushed the stock to the atmosphere and they're pushing it again because the short float is being covered. It used to be 30%. Now we're under 10%. When 20% of the float of any shares get bought, this is what you see: impulsive moves to the upside. Look at the weekly chart here. This is a high. We made a higher high on the chart, yet we made a lower high on the RSI. This is due for a correction as well, and the correction here is going to be more violent. Remember, when the stock went all the way up here, everybody said, oh, there's no correction, you're stupid, it's never going to happen. And it went down and it touched the weekly average, the 20 weeks in this case, and it pierced through it. This always happens. I've been doing this for years and years. When you extend over the 20 weeks average, you're going to come down to it sooner or later. And the sooner you do it, the more violent the correction will be. And when you look at the short float, is actually starting to kick back up in Tesla stock. So more educated, smarter shorts are entering the trade. The risk versus reward shorting here versus here is a lot better. And the correction could be blamed on Elon Musk's crazy tweets. He's been tweeting crazy stuff. The guy's absolutely losing his mind. One thing you don't do as a CEO of a company, you don't alienate your core customers, but he thinks he's invincible and he will find out that he's not the hard way. But keep in mind that whatever reason would be attributed to the correction in Tesla, the core, the heart of it is actually technical. You have to come down and revisit your 20 weeks moving average. All right, so we're heading to a very important week, very important, decisive beginning of the month, because last week was not a real beginning of the month of July. This week would be. Watch Apple, watch Tesla. As Apple goes, so will the market. That's all I got for now. If you found this video helpful, please subscribe, like, and share. And don't forget to follow me on Twitter.